Okay, guys, welcome to Fundamental Session 3. This is Suleiman speaking. I'm one of the co-presidents at the Society, and today I'll be covering using exchanges and storing assets. Okay, first of all, what is an exchange? A cryptocurrency exchange is an online marketplace where users buy and sell cryptocurrency. The largest exchanges by trading volume in billions of dollars are number 1, Binance, number 2, Coinbase, and number 3, FTX. These 3 exchanges are generally considered to be the most reliable and the most trusted. However, they're not perfect, and all of them have been hacked at some point. One thing to know is that you should be aware of the regulations around these exchanges in your own country, as they are constantly changing and new laws around cryptocurrencies and exchanges are being written as we speak. These exchanges can have issues sometimes, so you may have issues withdrawing your currency, your money, sometimes because the currencies are having a payment systems change or because they're overloaded. There's many different reasons that they might have issues, but generally speaking, these are the ones with the least issues. That's the best way to put it. Registration processes are the same as with any other website or application, except for one thing, and that thing is KYC. So what is KYC? KYC stands for Know Your Customer, and it refers to a process that banks and financial institutions use to gather identifying data and contact information from customers. KYC is important. Its purpose is to prevent fraud, money laundering, and other illicit activities. However, many people within the crypto space have issues with KYC. They believe it raises major issues surrounding privacy, which is one of the fundamental aspects that cryptocurrencies were meant to be built upon. And, if you identify as a cypherpunk, which some people do, just to explain, cypherpunks consist of a group of people that are in a movement which advocates for digital privacy in all forms, essentially. This is a whole topic of its own, privacy versus government regulations and control, especially in the cryptocurrency space. And, it's a topic for another day that I would enjoy talking about. But essentially, KYC is how central exchanges identify you as a person. And some people have issues with that identification process. So I want to, first of all, before I go to the next slide, take a look at what that registration process looks like. So to begin with, once you go on an exchange like Binance, which is one of the biggest central exchanges, you're going to meet the same page that you meet with any other website. If you don't have an account, it will ask you to register. Once you click on the register button, you will see a screen similar to this where you create an email, you input your email and you create a password, same as you would with any other website, really. And there's a phone verification process. So if you put your phone number in, it will send you SMS to verify that you on that device, that mobile device. This is just an extra layer of security, which is a good thing. So once you go through the verification process, what happens is that your page will come to a page like this, and this is the home page of Binance. And as you can see, I'm verified. You will get that verification tick after you have submitted ID, such as your passport or driver's license containing your name, surname, your address, and other ID verification tool and other things that identify you, basically. So just to go back onto the slide, once you have gone through, so you've gone through the KYC process, you're verified now, and so what's next? The next thing is buying and selling on these exchanges. So I want to talk quickly about the different orders you can make on these exchanges, the different ways you can buy and sell, and then I will give you a practical example on Binance itself. So one thing you can do is a market order, and a market order is essentially an order to buy or sell immediately at the current price. That's self-explanatory. You simply just buy or sell at whatever price the coin is at. A limit order is used to execute a trade if the price reaches a predefined level that you want. So let me give you an example. Assume you wanted to buy Ethereum, and let's just say Ethereum was at £10. You would set a limit at £10 when buying Ethereum, and this limit essentially means you will not buy it for more than £10. And assuming you already own some Ethereum and it was at the £10 market price, you would not sell it for less than £10 if you wanted to sell it. Okay, that's a limit order. Just let me explain that again. A limit order is an order used to execute a trade if the price reaches the predefined level. So whatever level that you set it at, whether that's 10, 20, or £30, you set it at a specific level that you want to sell it at or buy it at, and so the order will only execute once it reaches that level or below that level or above that level, depending on if you're buying or selling. Okay, stop limit. There are two prices specified in the stop limit order: the stop price and the limit price. And the stop price is essentially where it converts the order to a sell order, and the limit price, instead of a market order to sell, the sell order becomes a limit order. So that sounds a bit complicated, but if I just show you in practice, the key thing about a stop limit is that it gives you leeway. That's it. You have the stop, which acts the same as a limit order, and then you have a limit under or below that stop, which is essentially just leeway. So just to show you how that looks like in practice. Okay, so I'm on Binance now, and I want to show you, first of all, a market order. A market order is, I want 1 BTC, for example. How much would that be? And that would be 43,398 right now. A market order would let me buy it at exactly that price. That's a market buy, and a market sell would let me sell it at exactly that price, which is it's at right now, and that price is 4,337. So let me repeat that again. Market is selling or buying at the exact price the coin is at. A limit is essentially saying I want to sell at a specific price or buy at a specific price. So it's at 43,406, sorry. So if it's at 43,406, let's say I'm not going to buy it unless it goes up a bit more. So, or even a bit less. So I'm going to buy Bitcoin, let's say in this case, when it goes a little bit up. So 4,500. So if I set it at 4,500, then the order will only execute, the buy order will only execute once Bitcoin reaches 43,500. Sorry about that. A sell, it's vice versa. So a limit sell will only execute once it reaches, the specific sell price that you put in. So let's say if it keeps dropping and it drops to £40,000, then I want to sell Bitcoin. You'd put that price in, and the order will only execute once Bitcoin reaches £40,000. And the stop limit is essentially the same as a limit, but with extra leeway. So you'd set a stop first. So let's say I want to buy some Bitcoin. How would I do it using a stop limit method? Well, let's say I want to buy Bitcoin when it goes up a bit more, it has a bit more momentum. So let's say 45,000 pounds. Then that means usually 45,000 pounds. If it was a limit, you can think of the stop as a limit. I know it's weird because you have two limits, but if you think of the stop as the price you want to buy it at, a specific price, then the limit underneath that stop is leeway. So let's say it goes up to 46,000. So what I'm saying essentially is what I really want to buy it at is 45,000, but I'm okay at buying at 46,000. So I allow a leniency of about $1,000. So 45,000 is where the stop is at, and then the limit is that it will sell at anything between 45 and 46. But it will not, it will buy at anything between 45,000 and 46, but it will not buy at anything above 46,000 pounds. And the same exact thing applies. In the opposite way, if you're selling, then you essentially are reversing that. I don't want to take too much time on this. But at the end of the day, really, if you're starting off, the main thing you want to use is a limit order or even a market order. They're both okay. A stop limit is a bit more of a trading tool, but it's worth knowing about as well. Okay. So when buying and selling, you have to understand pairs. And why do you have to understand pairs? Well, trading pairs or cryptocurrency pairs are assets that can be traded for each other on an exchange. At the end of the day, you're not just going to get Ethereum for Ethereum. You're going to get Ethereum for something else. So you have to, it's like when you go to a store, you don't get the same exact thing that you're buying for the exact same thing you're selling. Sorry about that. So this is an example, BTC, Great British Pounds. That dash, it tells you it's a pair. Sometimes that you have a comma there instead, but it's the same thing. This essentially means you're buying BTC using Great British Pounds. And sometimes you also have the XYZ. This is just the example. It can be any coin /USDT. USDT is the most common, well, I shouldn't say pair. It's the most common coin that is paired with other coins. So USDT is found in a lot more pairs than, for example, Great British Pounds. And the reason for this is I believe it's just easier to pair your coin with USDT since it's already a digital version of the US dollar. Okay, so what would that look like in practice, or how many different ways are there that you can buy cryptocurrencies on Binance? So let me just go over. So one way I just showed you was on the trading page. This allows you to find many different pairs. So for example, you can find ETH with many different pairs. Got all these pairs that you have. You have Australian dollars, you have BTC and ETH, BUSD. This all essentially means that you're buying Ethereum with another asset, whether that be a currency, a national currency like the US dollar or Great British Pounds, or whether that's another cryptocurrency. The main thing is the asset that you see on the left side, that's the one you're buying. That's all you need to know. And the one on the right side is the one you're buying it with. You can, of course, buy on this page. You can also just buy on the once you click buy now, it will take you to this page, and this allows you to just automatically, instead of going to that trading page, if you believe that's a bit overwhelming for you, it lets you just buy straight away using Great British Pounds with any other coin that you want. BTC is there. You can also just buy ADA, all these other things are here as well. Avalanche, Atom. This page is pretty good for beginners. So if you've just opened an account, I recommend you just go buy now, and then you use your currency, whichever one that is, which takes you to this page again. You use your national currency to just buy it. That's the easiest thing to do. But why do I bring up pairs? Well, the reason I brought up pairs is because USDT has a lot more pairs than BTC, than Great British Pounds. I believe it also has more pairs than BTC as well. Like I said, the reason for this is what I mentioned before, where it's a lot easier to pair with already digital currency than a fiat one. Okay, so we've just seen how to open an account, how to buy and how to sell, and the different type of orders you can use to buy and sell. And this was all on a centralized exchange. But what are decentralized exchanges? Because there are such things as decentralized exchanges as well, and there is a lot to them. So the best way to explain what a decentralized exchange is, to use what I like to call the river metaphor, right? Because it's really just a metaphor for how it works, how a decentralized exchange works. Assuming you wanted to buy, let's say you wanted to buy some eggs, but the man that you wanted to buy the eggs from, he lives across the river, and you don't have a boat of your own. What central exchanges do is they act like a man with a boat. They bring you to the other side of the river to the man with the eggs. So they bring the buyer and the seller together, and then that lets you buy your eggs. So a decentralized exchange removes the whole need for the man with the boat. The boat is still there, don't get me wrong, because you need a way to buy and sell. But the man who owns that boat is not necessary. He's the middleman. So a decentralized exchange is basically an autonomous boat. So like a robot boat that just, keeps going side to side across the river. And anybody can take the boat and go to the person on the other side who is selling what they want. And just to give you an example of what a decentralized exchange looks like, this is Uniswap. It's one of the most popular decentralized exchanges. There's others like PancakeSwap. There's many more. And what they do, this one, it runs on the Ethereum network. I believe most of them do, but that's not really something you need to know. But the point is, it lets you swap anything that's on the Ethereum network, any coin that's built on the Ethereum network, into any other coin that's built on the Ethereum network. So all of these are built on the Ethereum network, and you can swap, one, let's say GRT, to really any other token. However, doing this is going to cost you ETH. It's going to cost you Ethereum to do it, because you need to pay fees to use that network. It's not free. But that's the idea of decentralized network. It means you don't need to go through a company like Binance, because at the end of the day, that's a company owned by a CEO and shareholders. However, this is not owned by anybody. It just works off smart contracts. That's it. Okay, so now that you know how exchanges work, how to register, and then buy and sell, and what the different orders do. The question is, what kind of strategy should you use? How much should you buy? How often? When should you sell? And a large part of this depends on what you like to do, what your method of buying and selling is. And there's really two main methods. That's trading and investing. They're like two principles of buying and selling. Well, anything really, stocks as well, any commodities. Trading involves buying and selling at a shorter time frame. Investing involves buying and holding the assets for a longer time frame. Trading, I'd say that's like hourly, daily, weekly, and investing is more monthly, yearly. Personally, I wouldn't consider anything less than a month like real investing. But I'm assuming there's some people that do. But anyways, traders, they may trade one coin or token, but generally do not hold them for a long period of time. Whereas investors can be, they're also not locked down in, holding one coin forever. They can be active, which means they can adjust their portfolio, buy a new coin or sell a coin if it's not doing too well, after a long period of time. So generally traders are, they're looking to profit from changes in trends. So in other words, volatility is what they're looking for. And this can be both a pro and a con. It can be a pro because that's how they make their money. If they buy low and sell at the right time when the price has gone up, then they've made money off that volatility. Whereas investors, they generally want to accumulate as much wealth, as much of the coin as possible, hold it, let it grow, like this picture. But however, investing still requires a lot of attention and consistent research. But at the end of the day, I personally would recommend that you especially if you're starting off, you're early in the game, I'd recommend that you just invest. So you do a lot of research on a coin that you like, and then just hold it for a little bit to see where it goes. Trying to trade on an hourly or daily basis is very, very difficult. There's a lot of things involved, technical analysis, constantly looking at the price, lots of research as well. And generally speaking, traders are less profitable than investors just because it's a lot easier to go wrong in a shorter period of time. The easiest thing to do is really to just invest and hold. Anyways, so you decided, let's say that you want to be an investor, you want to buy some coins, you figured out how to register with Binance, you have your account, you started buying now. So what you want to do next is the question is, where do I store the assets that I buy? Well, the best place is with either software wallets or hardware wallets. And I've put there at the top, not including exchange wallets, because these are not real wallets. Any coins that you have on exchange are not really yours. You don't have true ownership of them until they're either, in a software wallet. So one of these platforms like Coinbase, their native wallet, Trust Wallet, or Exodus, I recommend you use Exodus because it looks really good, it's clean, and it's easy to use. So just to explain what software wallets are, they store the coins within the software on your computer or mobile. You have an address for each coin or token on the wallet. So Ethereum has its own address on Exodus, on your account as well. So that's two things to focus on. You need to focus on the coin's address. Make sure that you're sending it to the right address, because if you have owned some, let's say Ethereum on Binance, and you want to send it to your wallet on Exodus, to your wallet address, you have to make sure that you have the Ethereum address on Exodus, right? Because if you send it to, I don't know, let's say your BTC address on Exodus, you're not going to get those coins because you just sent it to the entirely different address and the wrong network. So those coins are gonna, please don't make that mistake, guys. Make sure you send it to the same address as your wallet. and the right coin address as well. Okay, so a seed phrase allows you to access your account on any platform, and the seed phrase is given to you when you're making your account. In the beginning, this is basically, it's not even just a password, it's your username and password. It's everything in one. So you don't want to lose this, and you don't want to be giving this away, because it's instant access to your wallet if you do. A lot of these wallets, software wallets, they have many of them. I know Trust Wallet does, MetaMask, that's another one. Coinbase, their wallet also integrate dApps. And dApps are decentralized applications. I'm sure one of these sessions we'll talk about them coming up. Uniswap, the one that I just mentioned, the decentralized exchange, that's a dApp. Okay, what are hardware wallets? Hardware wallets are physical wallets. They don't really look like, normal wallets. They look more like USBs. And they're more secure than a private wallet. So, if you want that extra, that was meant to say they're more secure than a software wallet. So if you want that extra added layer of security, what you can do is you can get one of these. And the way that they work is that they store the private key. And if Hassan covered private and public keys in the last session, essentially what it is private key demonstrates real ownership of the address. That's it. If you have it, you have real ownership over access to that address. And one thing to notice is that the coin itself is not in the wallet, by the way. When you store the private key, it's not the coin in there, but the key that lets you access that coin. Okay, next. This is, I believe, my last slide. But one key thing I wanted to really talk about was doing your own research. Okay. DYOR is something you're going to come across a lot. It's an abbreviation for do your own research, as a common slang in the crypto world. Why should you do your own research? Well, if you don't, you're a lot more likely to fall for scams. Okay, then how do you do your own research? Well, one thing you can do is ask really basic questions like, what does the project do? How much social media presence does it have? So you can look at, coins, Twitter, Instagram, Facebook, see how many people are following, talking about it. It's a good indicator of usually if there's some suspicious activity or not. You'll see that what people are saying, how they're reacting to it on social media. And it's always good to see who's the face of the project. It demonstrates some accountability to know who the face of the project is. If they put up a picture, it means, that they're willing to share things about themselves and they're not trying to just run away with your money. Another thing is that you should avoid anything that promises insane returns with no cost. There is always some risk, always some cost. I think the more they talk about, what's some of the weaknesses the project has, the better it is, the more trustworthy it is. But if they talk about it like it's perfect, then it's usually a sign of some issues, even if it's not a scam. I recommend you do minimum like 3 to 5 hours of research on a project before you buy it, just because, that's minimum really, just because it gives you enough time to figure out like what's going on. Is it even worth buying? And last note, white papers are your best friend. And the reason I say this is because the white papers are documents that each cryptocurrency or project puts out, or at least that they're meant to put out. And it just details everything that they do, what their plan is, how their tokenomics works, and what their plan for the future is. And yeah, really, as long as you're doing these 6 things, you should be able to avoid pretty much all scams. So that's it, guys. That's the basics of buying and selling on exchanges. I spoke a bit about decentralized exchanges and wallets, a little bit about them as well, how to store and what wallets to use. Again, just to reiterate, if you're in the UK, Binance or Coinbase are pretty good. Just open an account with them. It's a pretty simple process. And Exodus is a very good wallet as well for first timers. If you have any more questions, reach out to me or Hassan. And thank you for watching, guys. Take care.